I'm Karl Kiley, your San Diego realtor. I'm back with Matt.Kish from Movement Mortgage. We had a lot of volatility that happened over the last, I would say, week and a half. We had Trump announce these crazy tariffs, which we had Taco Trump show up over the weekend. Then we also had some uncertainty in the markets with regards to, I'll say very ignorantly, some smaller scale banks, but all of these things are having an impact on market. So we're gonna get the full update from Matt.Kish again with Movement Mortgage. Matt, thanks for joining me again, keeping us updated on the market. How's everything been going?
Everything's good. Thanks for having me. Always good to be here. Always good to be helping to inform the people of San Diego and out there in the sphere. So let's get it going.
Wonderful. Okay, so let's dive into this. When the biggest thing we talk about a lot on this channel, but I feel like real estate agents and mortgage loan officers profess extensively is that the Fed funds rate does not have a direct impact on mortgage rates. So we tell people, hey, watch the 10-year Treasury. There's not an influential relation, but they tend to follow each other, right? So this last week, we had the 10-year Treasury drop below 4%, which it's been stuck above that. I'm sorry, drop below 4%, is that correct? Or drop into 4%?
Just below right around. We've been hovering around 4%. We've been staying above it for a long time, but our goal has been, and what we've been talking about and building the momentum towards, has been 4% on the 10-year note. And we've crept down and down and down, and we finally hit it. We've bounced off of it a couple times this year, if you remember, right before the Fed cut their funds rate here about a month ago. And back in like May, April, where it dipped down for like 48 hours, and we were right here in a good spot. So here we are again, right back down towards 4. And it's not always rule of thumb, but it's basically rule of thumb, Karl. Like the mortgage interest rates are gonna hover about 2% to 2.25% above the 4-year, the 10-year note, right? So if the 10 years at 4, the 30-year interest rate, fixed rate is going to be right around 6%, 6.25. And here we are. So as we creep below 4, we might see the 30-year fixed rates kind of get into the 5s, where we're probably going to be hanging out for a little bit.
Awesome. Thanks for helping me there. I was like stuck. I'm like, wait, is it 4.99 or is it 3.99? But once you said, I'm like, oh yeah, we broke 4. So with that being said, we've kind of bounced off of it. When we came down this last week, 3.99 or whatnot, we didn't see mortgage rates dip. We didn't see mortgage rates kind of trend down as well. Can you give us a very like meat and potatoes, maybe sprinkle a little bit of carrots and peas on the side on the relation of the 4-year Treasury to mortgage rates and like why that might have not happened? Like why didn't mortgage rates go down a little bit more?
Well, in reality, they kind of have been trickling down a little bit more, as the weeks have progressed since the feds have cut their rate, right? Then the government shut down kind of simultaneously after the Fed cut their fund rate. We went into the shutdown. So there hasn't been any labor data or any major financial report that has come out to really sway any of these markets to move these numbers in a major form. But if you've seen since the government shut down till now, and as the 10-year has crept towards 4, the interest rates have kind of crept back down to where they were before the feds cut their fund rate. So we're back to living kind of more comfortably and where we wanted to be coming out of summer as far as those rates were concerned. But as far as the yield, the spread is concerned between what it was and what it is now, that has a direct correlation with investors, right? Now, the investors in these mortgage bonds are going to want a little more for them holding these bonds for a longer period of time, right? So now that there's institution banks, human beings buying and selling and holding these notes, and not the government, who were the biggest buyers and sellers of these 10-year treasuries for the last 6-10 years. Now that the Fed's out of it, these investors are going to want a little more bang for their buck. So cheap money isn't cheap money anymore, right? So that's kind of the why the spread is still a little higher than historic norms, right? Probably about a point higher. But that's because not only are the investors wanting a little more bang for their buck, the government's out of the buying and selling of the bonds market, but we're also carrying this big debt. And as you refinance these debts and kind of repackage them, you're going to refinance them into a higher rate. And so that's why the spread's a little higher than the norm. But this is probably going to be the new norm.
Got it. So for those watching, when Kish talks about the government buying a lot of the debt and whatnot, you've probably heard these terms before, but it was referred to as quantitative easing and quantitative tightening. So the government backed off from buying all these mortgage-backed securities, and now we are relying on investors buying these. So they want a little bit more return on their investment, where the government would not seek as much return in an effort to stimulate the economy. Is that about right, Kish? Beautiful. Okay, let's move into the next topic. Last week we had three, I would say smaller-ish, banks announce some concern on their books. And then more importantly, we had Tricolor, which is one of the largest subprime car loan companies. And you're probably wondering, Karl, wait, you guys talk about real estate, hang in there. What I'm wondering is this company, like the car market has been this interesting scenario since 2021 when values just got jacked up so high. You have, I'm seeing people talk about repo rates are so high, and there's like these lots of all these cars that are just sitting and their values are so high. There's a big concern for Teslas. I think it's in 2026. They're talking about all these leases returning, and the resale market on electrical cars is so tanked. Like the Porsche Taycan is selling for 60% below value after 2 to 3 years. So you have like all of this stuff going on in the car market, and there's people wondering, is this the canary in the coal mine that might be telling us we're on the precipice of some serious market concern? And could this concern, we don't need to talk about how those dynamics might influence mortgages, but is this concern about the market, is that showing up in the mortgage side? Is it showing up in mortgage-backed securities and the bonds and et cetera?
So short answer, no. This is definitely a red flag. Like, don't get me wrong. Like, anytime major institutions shut their doors, you gotta kind of wonder why. But I mean, the biggest take from that statement that you just said was subprime, right? So they're already lending to risky people, super risk adverse. So it's the subprime ones, the ones that are already lending to people who shouldn't be lent to, or kind of questionably should be lent to, are going to be the first ones to kind of crack, because obviously their clientele, their borrowers, and the people who are financing with them are going to be the first ones not to pay. And before the housing market crashes, right, you're going to see other markets crash. You're going to see credit cards go into collections. You're going to see repossessions on autos. You're going to see repossessions on boats and motorhomes, and that's going to take a period of time. And then that period of time, the data is going to have to collect from that period. So we're still a long time away from the mortgage side of things really being affected by the auto industry side of things. But you can't just be like, that's a one-off, no big deal. We got to really pay attention to that, because if this is the canary in the coal mine, then what is that going to do for underwriting standards? What is Fannie Mae and Freddie Mac going to do as far as tightening their screws when buying these bundles on the secondary market, right? So as the credit adversity kind of builds up, right? Because we're seeing it, and we've been talking about it for months and months and months, is this country is in more credit card debt than it's ever been ever. This 5-year period of time since COVID to now, where we have jacked our credit cards through the roof. So now that bubble's got to kind of pop, but we've also talked about it too. Thank goodness there's so much equity in this country that we could probably dig ourselves out of that. But what's after that? Once we take away all of our equity because of we're digging ourselves out of this credit card debt, once that bubble's popped, what's next, right? And that's kind of scary. So once we see maybe that dynamic switch, then all the red flags are going to pop up. But this Tricolor is kind of a one-off, but we got to keep an eye on it. You know, that's our job. We got to always know what's going on. But this isn't a direct trigger to really worry about the mortgage stuff.
Yeah, I think I agree with you. I think that it's something to watch. There's some people that are, I see on these YouTubers talking about, oh, this is the precipice, this is the straw on the camel's back. And it's like, I think that there's other dynamics that they are just completely, they might be oblivious to, they might just not know any better. But there is a overwhelming portion of the market that, one, either has no loan on their house whatsoever, or two, they have such ridiculously low mortgage rates that it's cheaper for them to stay in their house than it is for them to go rent. And to suggest that the car market is a sign of devastation and everything's gonna go south, it seems like the housing market, there's so many of these maybe not intentional prevailing securities built in based on no mortgages and then these really, really low rates. The FHFA refers to it as the lock-in effect. People who have such these, are also known as golden handcuffs. People have such low mortgage rates that they just can't sell. They have to stay in their home, you know, because for them to move up, it's just too expensive, even if it's to go to rent, unless they move elsewhere.
Right. Well, and Karl, sorry to cut you off, and you compile that kind of with the labor market right now, right? So kind of dual effect. You're saying credit cards through the roof. The only thing kind of to save that is the equity. And now on the job side of things, the demand for jobs is low. The hiring and firings are, you know, everything is mute. So you can't really move. There's no movement there other than making sure that you don't have to sell first and that you could do something about getting a home equity line of credit with these Fed funds rates coming down. That's going to be the next step because HELOCs are going to be cheaper as the Feds lower their funding.
Oh, I didn't even think about that. So the credit card debt could be, I don't want to say wiped out, just repositioned with HELOCs under lower interest rates, and that might. Oh, that's a very, very interesting perspective. That's possible because I can remember in the early 2000s, before 2008, people used HELOCs to buy all of their stuff and to consolidate a lot of debt into their house. So that could be on the horizon there. Very, very interesting. Okay, so last question. We have a lack of data. We have these like we've kind of talked about, these banks and subprime lending, these kind of concerns. You mentioned, you know, we have the labor market is not only the unemployment is slightly creeping up, but we have extended unemployment claims. We have it's not as many new jobs opening. We have people having a harder or slightly more layoffs. Is that correct?
Correct. Everything is just muted. There's not hirings. There's not too many fire other than the government sector. There's not much creation. There's people who are in their jobs or staying in their jobs. And you know, the people who are on unemployment are staying on unemployment. So everybody is pretty much on the same path moving forward as they were last year, right?
Perfect. So we have all of this stuff going on. It was talked maybe a month ago of our call, not 2 weeks, but maybe 2 calls ago. We talked about how, okay, we're going to get our first Fed funds rate cut for the year. We're going to get another one. But now if you look at the CME watch tool, it's like a 99% chance that they're going to cut at the end of this month. And then it's like a 96% chance that they're going to cut in December. The expectation is that they're going to do a 1/4 point each cut. My question, my long way of getting to a question here is, what would it take? What would need to break for the Fed? I feel like kind of coming in with 3 cuts at the end of the year is pretty aggressive. What would it take for the Fed to be real aggressive and make one of those cuts a half point rather than a quarter?
I would say us coming out of a government shutdown and getting like a slap in the face jobs report that we like had to scramble about, right? Like the unemployment numbers were so high that the Fed had to do something to, get the economy going faster. But I mean, do you see a government shutdown, end in sight? I don't. Also, I would say that would be kind of unprecedented as well, knowing that they just cut the fund rate. There's only a couple more months left in the year. And they've already given some language to what's going to happen first quarter of 26 with another possible cut. So going 50 basis points, it would be there again. There would have to be a crazy job number, a crazy something, ADP, something would have to come out and be like, red flag, alert. But I don't see that happening, and so here we are. But again, as we've seen last year when the Fed cut their fund rate, last month when the Fed cut their fund rate, mortgage rates didn't really like it. So we're talking about mortgage rates. The Fed fund cutting their rate, again, is going to help your auto loans. It's going to help your home equity lines of credit. It's going to help some credit cards. It's going to help things of that nature, but it doesn't always directly influence mortgage interest rates. And as we've seen, it's kind of actually been the latter. It's kind of hurt mortgage interest rates for a little bit. And we've recovered and got all the momentum back since the last cut. But again, this is what happened last year. We took that big hit compiled with last year's crazy job reports that we were getting too. That didn't help last year. But again, this year took a little small hit, 3/8. It doesn't seem like a lot, but I mean, it's taken almost a month to recover from it. So it's real. So we keep a close eye on it. But again, really know that the Fed fund rate doesn't always influence mortgage interest rates, just to be clear.
Yes, and we will exhaustively reiterate that over and over. And I think what we can point here is, the bonds rate gets ahead of the Fed. So if we got bad labor reports in, that would affect mortgage rates before that, like that impacts mortgage rates, and then that stuff impacts the Fed to follow, right? So that might be why we have that like little bit of a rebound, because mortgage rates have already adjusted according to other data, not because of the Feds.
Well, as we know before, like these mortgage interest rates follow trends, right? And as we know that the Fed's going to make a cut in the future, the now mortgage interest rates are taking that into consideration. But in real time, when the Fed cuts their fund rate, mortgage interest rates in real time don't directly follow. It's not a direct effect. It's kind of a delayed effect, right? So mortgage interest rates are coming down right now in response to the Fed cutting the fund rate in the future.
Yeah, exactly. So just to reiterate, and we might be beating you over the head with a hammer. Forgive us. Fed funds rates do not have a direct impact with mortgage rates. So if you're interested, if you're wanting to explore your options, see what is available for you in your credit, maybe you're 6 months out. There was an article, on Realtor.com that talked about if you're looking to sell, you should start planning 6 to 10 months in advance. It's the same thing if you're looking at buying. If you're looking to buy, you should start planning 6 to 10 months out. And it's a very, very good move for you just to call Kish. Hey, I'm looking at buying a house in the next 6 months to a year. I watch your guys' channel. Can we set up a call to talk about what I need to be or what needs to be, what I can work on between now and then so that I can be in a really good position to buy? All right, and that's it for this week's call with Matt.Kish. Thanks for joining us again. Do you have any closing thoughts or anything you want to leave the audience?
Just go out, tell your neighbors that you love them.
Wonderful. I like that one last time too. So, all right, any thoughts, questions, concerns, don't hesitate to reach out. And I have Kish's contact info in the description below. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you in the next video.